Good morning, everyone, and welcome to this fireside chat on capital markets. My name is Daniel Sadhu, and I'm the APAC Head of Sales for Smartkarma, based in Singapore. I'm delighted to welcome Ike Song from China Renaissance for this fireside chat. Ike is a Managing Director and Head of International ECM at China Renaissance. He's been working in global ECM markets since 2006. Prior to joining China Renaissance, Ike was a Senior Executive Director at Morgan Stanley ECM team, working in Hong Kong and US capital markets. Ike started his investment banking career at JP Morgan as an analyst. Welcome, Ike, and I'm delighted to have you join me for this fireside chat.
Yeah, thank you, everyone. Can you hear me okay, Daniel?
Yeah, I can hear you fine.
Okay,
It's great.
great.
No problem at all. So, what I'd like to do is, chat with you for about, 20 minutes on various topics, get your insight on them. And then hopefully we can open up the floor to some Q&A from participants.
Yeah, sure.
Okay, great. So, let's get started. So we've seen the start of what we think is, a wave of secondary listings in Hong Kong.
Yeah.
What's your thinking perspective around, what's driving this? Is it to do with increased, China-US tensions? Is it a more friendly listing environment in Hong Kong? What's your perspective around what's driving this?
Yeah, I think starting from this topic, we also need to look at the history a little bit, right? So secondary listing in Hong Kong is not a new concept. We've seen many precedents in the past. For example, HSBC, Standard Chartered, Manulife, etc., were among the first few pioneers in the 1990s. They were mostly big financial players, right? And then it came the China rally in the early 2000s, and we started to see another wave of natural resources consumer companies choosing Hong Kong as a viable listing venue. That includes like Sinogo, South Galbi, Rousseau, and also Fast Retailing, which is the Uniqlo group, and Coach from the US. They are listed as a HDR and other products in Hong Kong that didn't really work so well. So at that time, I think companies were looking for new money in this part of the world. And with China's ambition, with China's ambitious economics and infrastructure plan, Hong Kong became the jumping board for all these foreign companies to introduce themselves to China while enjoying its attractive valuation to raise funds here, right? Just give you a little bit of reference. During 2006, 2007, HSI was trading at 16 times PE versus about, I think, 15.5 times PE in S&P, right? So it is attractive to issuers to consider Hong Kong as a listing venue. But currently, it's trading. Currently, the HSI is trading at 9.8 times, whereas S&P trading at 22 times. Obviously, there are earning adjustment in S&P when the PE is so high. But I'll delve into that later on. Why even in a lower multiple environment, we still see this wave of secondary listing, right? So at that time, to encourage large natural resources companies to list in Hong Kong, Hong Kong Stock Exchange also adjusts its listing requirement to accommodate these companies. The Chapter 18 was designed especially for mineral company listing in Hong Kong. And then we also see the biggest mining company, Glencore, dual listed in Hong Kong and London, which is a milestone for Hong Kong Stock Exchange on the international stage, right? So the company at that time, Glencore, successfully raised $10 billion in the IPO on both exchanges. But that wave did not last for long, maybe 5 or 6 years or so. And most of the companies listed between 2000 and 2010 did not really perform well. And for example, Coach has delisted, Glencore delisted, and followed by many other delistings out of Hong Kong Stock Exchange. Right. So now we're seeing a new wave of secondary listing in Hong Kong. I think it started with Beijing, which is a biotech company listed in the US, and then returned to Hong Kong in August 2018. And this was, and the return of that also signaled by the change of exchange listing requirement for biotech company as well. So the Chapter 18A, allowing the early pre-revenue biotech company to list in Hong Kong, that's back in April 2018. So that also was one of the factors encouraged Beijing to return. And then also in 2018, Hong Kong adapted the weighted voting rights company. So with that put in place, the most noticeable one returning is the Alibaba, and they relisted in Hong Kong in November 2019. So Alibaba actually looking at Hong Kong as a primary listing first, but due to this weighted voting right issue, they chose the U.S. Because the Chairman Jack Ma would like to remain control of the company. So I think in 2019 or 2020, the upcoming year, this wave, as we can see, is not driven by the big foreign company, financial play, or mineral companies, right? It's really driven by the high-tech, high-growth, large-cap Chinese companies that have built themselves into a global player in the past decades, right? It's very different mentality, I think, to the investor base here versus the previous two situations, right? When you see a decade ago, the secondary listings are these large foreign companies trying to take advantage of the China rally and the attractive valuation that multiple investors in China are willing to pay, but they failed because they didn't really understand the Hong Kong market at the time, right? To be very honest, the investor base in Hong Kong, even though they are very international, they were and still are mostly focusing on China, right? They were either country specialists or sector specialists with abundant experience investing in China, and they also have the local know-how with a deep understanding of how a business is run under the Chinese regulatory environment, which is very important for these companies to succeed. However, but the investors, they have very little interest in learning non-Chinese company listing in Hong Kong, and then it's hard for them to follow up as well. So in that sense, it's very hard for them to pay up a premium for the valuation. I think that's why the previous wave failed. But I think this wave, right, ever since Alibaba successfully completed its secondary listing in Hong Kong in November 2019, the market has been expecting news of other companies planning to come back following this footstep. And then the evidence being JD.com and NetEase, the other two large internet company in the US, are seeking secondary listing application in Hong Kong. And then according to the news report, they already filed an A1 application confidentially on the Hong Kong Stock Exchange. So I would say this will be a pull factor, right, from the Alibaba that created. I see many other US listed Chinese companies are following the suit. But there's also kind of a push factor from the US, which is the recent political tension and I think the Luckin fiasco that created a push factor for the company that are currently in the US to look for a secondary listing venue that's safer and also closer to their operating geography. So I think with that, you see this wave of coming back is more encouraged in the current market. And also I think that China and Hong Kong build up the Stock Connect program, allowing money to flow in and out of China, that potentially increase the fund flow into these China A terms, right? The Stock Connect program has made a profound impact in the investment landscape in Hong Kong. According to the Hong Kong Stock Exchange report in 2019, we have seen 12% of the fund flow coming from mainland that contribute a large trading volume in Hong Kong versus US investors contributing 10%, UK investors contributing 7% respectively. And then I think yesterday the southbound flow was at 21%, which is a relatively high in the current market sentiment. So I guess, so this will be another key factors the issuers are looking at from the US and then coming into Hong Kong to enjoy that fund flow and support from the secondary markets. I mean, but however, I don't think all the China ADRs are eligible. In short, the companies thinking about returning to Hong Kong will need to have at least $5 billion in market cap at the time of listing. Mm-hmm. And they need to have 2 years of public financial filings. Simply put, they will need to be listed 2 years in the US before they can consider this listing, this returning in Hong Kong. So I guess we'll see how it goes, but we think there are also about probably 10 to 15 companies looking at this, and they're eligible to come back.
Okay, that's great. That's very insightful. You know, from what I'm hearing from you in summary, it's really, better understanding of companies. You know, I think and second, with these Connect programs, a lot of support from fund flows. So it sounds like, this wave is built on solid foundations.
Yeah.
As I think I get the feeling from what you mentioned earlier, some of the previous waves, a little bit shaky, the foundations.
Yeah, and also they don't have the regulatory support. I think that's
right. Yeah. So on a related theme, there's obviously a lot of Chinese TMT, internet kind of companies, looking at secondary listings. Do you think in a post-COVID world, are you seeing demand from other sectors, for example, healthcare? Do you see that, as a sector where there would be appetite for secondary listings, given, in a post-COVID world?
Yeah, definitely. I think healthcare companies are still choosing Hong Kong. I think the Chinese healthcare company are still choosing Hong Kong as a main listing venue, given the preferable listing requirement that was laid out by the exchange, right? So I think since April 2018, you see, I would say over 50 of these companies, big and small, listed in Hong Kong on a pre-revenue basis, and they are very similar in terms of specialization, right? I think more than 50% of them focus on oncology. And then they do see as a pre-revenue candidate, it's hard for them to look for funding internationally. But with the Hong Kong Stock Exchange offering that platform, they can develop their drug even with no revenue in sight, right? As long as they have a license, which means as long as they have the technology and the know-how, the Hong Kong Stock Exchange do want to support them, right? I think Beijing's return, it's a good sign for the healthcare company to come to Hong Kong, and then you see the split of healthcare listing in the US and listing in Hong Kong. You definitely see the significant pie in Hong Kong, right? But so as long as this company performs and deliver their results and have the progress on their research and development in the drugs, they will do well in the Hong Kong market, given this is it's a job well done by the Hong Kong Stock Exchange of attracting these companies and stopping them flowing out of the country and remain them into the China-Hong Kong regime.
Okay, that's very insightful. So it's not just TMT and internet. I think you're seeing strong flows and interest in things like healthcare companies. So there is more broader sectors coverage. So
yeah,
let's move on to the next topic. The crux. Show me the money. Valuation is key. Doesn't matter in private markets, public markets. Doesn't matter what asset you're buying.
Yeah.
I think it's fair to say that in public and private markets, there has been, especially over the last few years, significant valuation discrepancies. I think take Uber for example. What their private valuation is. I think we all know now what their public market valuation is.
WeWork.
WeWork. Yeah, I didn't even get there.
Yeah.
Given recent deals for private companies who are coming to the market, do you see investors asking for an IPO discount? So interesting to get your views on this discrepancy between private and public market valuations.
Yeah, sure. I think in the recent years, we see many unicorn kind of rise and fall, to some of the examples that you mentioned, but we also seen some really successful ones, right? And I would like to discuss a little bit of observation that we have seen in the recent market.
Yeah.
I think the IPO discount is a fairly standard, metric that you use in the equity capital markets. It is usually discounted given the risk profile of the company being private that never gone through the public scrutiny before, right? Also the lack of liquidity of the private shares they currently have and the track record as a long-term company. And obviously the market condition at the time will contribute to the discount as well. But usually the discount will range from 10 to 15%, for a private company to gain that listing status, to get that liquidity in the public market, and also to get the money, right, from the IPO, which is most important part for these companies. So they are willing to take at the 10 to 15% discount. And the final discount rate also contribute to the company's fundamental and the growth factor, as well as the industry it's in at the time, right? However, in the recent deal out of Asia and China, maybe in some other regions too, but we see that in China more significantly, especially at the end of 2018, we see a much bigger discount required for them to successfully list, not just in Hong Kong, but also in the US as well for Chinese companies. And sometimes these discounts might eat into the last round of valuation they have raised through private equity investors or venture capital investors. So I think I can give you some example. For example, Tongcheng Yilong, which is the Ctrip comparable travel company in China, their IPO discount was about 28% to 45% to Ctrip at the time of the range. But obviously when they priced it, I think it's closer to the tighter discount than the wider one, but it did set a wider to attract investors, right? And then Baby Tree, which is a small cap kind of mom and children products companies, the mothers and children products company in China, and that was also discounted 20 to 40% to Alibaba, which is another e-commerce company that they calm themselves with, right? And then Yunji was 20% discount to the last round, and Mogu, which is also e-commerce company, that was done at around, I think, 30% discount to the last round as well. So at the end of the day, why do these phenomenal happens, which is a little unusual for the investors, right? Because they participate in a company early on, and they have done their own due diligence. They believe in the value of the company. But when you see a huge discrepancies, you probably have to ask yourself what happened in the valuation process on the private investors round. And I see the reason being probably threefold. I think number one is the Chinese rally really set a mental expectation for the issuer and the private equity investors, right? During the early 2000s, it seems every unicorn they invested in all do really, really well, right? So every round they see a 50% to 100% increase, even within a short period of time, right? So, and then they realize those gains, even though it's a little bit preposterous in terms of the fast of growth rate versus time, but they did realize that gain at the end of the IPO, right? But after 2010, I think that mentality kind of shifted a little bit too, right? You see all the big companies, all the good company has listed, but the mid-range or little mid to small cap company also looking for the same return, or looking for the same kind of trajectory on the valuation, right? So number two, we see that the disconnect between the private investors and the public investors. So the one I quoted, and some of the unicorn you quoted would be the examples that you see that private equity guys value the company in a way that they understand, with the assumption that they think makes sense. However, public investors may not accept that assumption or the growth rate, right? I think they all using the same valuation methodology or similar valuation methodology, right? DCF being pretty dominant one to check against each valuation, and also you have the trading multiples on PE or sales to revenue or enterprise to revenue basis, right? But the thing is, what the put a on the growth is very different than what a public company can accept after 10 years. This exponentially growth. So that could be the second point. And then the third point, I think, in order to reconcile that, or to have a healthier private to public route for all these companies, would be the understanding between the private investors and public investors, right? I think the private equity investors need to understand that the public investor have sometimes a more conservative expectation on growing companies. Like 30 to 40% growth rate, it's something more accustomed to their to their normal, right? But when you're talking about 80 to 100% growth rate, you really need to put in the sustainability in mind, right? So for private investors, they might think about 5 years, 3 to 5 years of exit. So that growth rate, that robust growth rate is probably justified for a company in early stage in the first 3 to 5 years on this trajectory. But when you think about public investors who are buying this company for the next 10 years or so, they are looking at it very differently in terms of how this rate can be sustainable, right? So that's why they might not be able to willing put on that kind of valuation the private equity investors are accustomed to. So that would need some time to, I think, for both sides to come in and understand their assumption, understand what they're looking for in order for the IPO discount to return to normal, and to see some of these companies to come to the public and enjoy a healthier aftermarket performance, right? And then especially if you look at 2018, the end of that year's IPO in Hong Kong and the US out of China, they all performed very poorly. I think the average the average aftermarket performance in 2018 year to date on the IPO market was, I think, 15% below the water, right? So that's something we hope to reconcile, to hope that they will disappear in the future public.
Okay, so I mean, from what I'm hearing in terms of summary from that question, quality counts. You know, if you're a good quality company, you're going to get a good valuation. And the second thing is, you know, people, you know, have got to understand in terms of growth rate assumptions. Are you looking, you know, the short run or the long run? So there needs to be a better, you know, match between people's understanding of those kind of growth rates. You know, you can't expect companies to be growing 80, 90% year on year for the next 10 years. I mean, maybe some companies that can do that. So there needs to be a better understanding of that. Okay, great. So thanks for your thoughts on those two topics. I've actually got quite a number of questions from the attendees. So I'd like to spend the last 5-6 minutes on trying to get, you know, answer a couple of those questions.
Sure.
So first question is, how serious is the decoupling of China and US, and how will this impact capital markets and the M&A space?
I mean, I don't think the decoupling of China and US will really happen that quickly, right? There are a lot of tension in the trade, in the kind of the fraudulent companies, the selective few fraudulent companies that hurted the U.S. capital markets, the U.S. investors, and then also the Huawei situation that intensified the M&A space on the TMT side. But I think it really depends on how the U.S. react in the next in the rest of this year, I guess. The COVID recovery will be one of them, and how U.S. will really hold China responsible for that. And then second of all, I think it also depends on who will become the president after November, right? If Trump continue his term, I think it will accelerate the decoupling, right? But if Democrat won the election, I think the relationship between China and U.S. might ease up a little bit.
Okay. Next question, Luckin Coffee. Short-term or long-term pain for the credibility of Chinese ADRs?
Personally, I think it will be a short-term pain. We actually had an extensive discussion with the investors in the U.S., especially on this topic, because a lot of our issuers, our clients who are looking for U.S. IPOs are concerned about this factor. And then the general feedback we got from long-only investors are that they usually do their own work on all these due diligence on new companies from China. They understand the intransparency of the accounting. They understand the risk of investing in China. And obviously some long-only did experience a huge loss from Luckin Investments. For example, Capital Group, they are the big holders for Luckin before this fiasco happened. But a lot of other long-only investors still have the belief that their own due diligence and work is sufficient to invest in China, they will have some definitely some pushback now from the internal investment committee and taking a closer look at every company they invested in. But I don't think it will really push back U.S. investor in investing Chinese company, and that's the feedback we got from a lot of long-only investors in the U.S. Whereas for hedge fund investor, they really see this as a trade. Right, they see the volatility increase in the China ADR, and then you also see the China ADR index in the U.S. kind of go up and down 2-3% a day, and then you see that the hedge fund guys definitely making some gains in that volatility. But in the long term, as long as these companies can deliver and this company can make a reasonable profit and return versus the other companies in the U.S. or other region, I think investors will still put in money in China, but they just need to do their own work more diligently. And then I just want to add, this fraudulent cases from a Chinese company is not the first, right? And then we all know it won't be the last. And also, it won't just coming from China, right? We see a lot of fraudulent cases from the U.S., from Southeast Asia, from Europe as well. So I think the Luckin case is amplified, number one, due to its size and its spotlight as a unicorn from China. And then number two, it's also because of political tension at the time between China and the US, and it got magnified.
Yeah, I think that's a great response. Investors should be doing their due diligence. And as you correctly said, frauds and scandals happen globally. It's not just in China, it happens in US, Europe. I think just people can pick on China, but I think they really need to understand these things happen globally. So last question, and really quick. We've seen news on RFI QFII quotas being lifted now. Does this diminish the appeal of Hong Kong listed China? Real quick.
Yeah, so for that quota to be lifted, it definitely helped. But the thing is, the lift of the quota means they don't have to report as often, and they don't have to they don't have to have a ceiling of investment. But the thing is, in order to get a quota, they still have to go through the similar application process. So it still adds level in order to invest in China. Whereas I think the northbound flow, which is set up in Hong Kong to get into China, it's much easier. So you don't need to go through that special application process in order to invest in China. But obviously, if you want to do direct investment or primary investment, you will need to apply that quota. But if you want to just enjoy the secondary trading and the liquidity of Chinese market, going through Hong Kong via the northbound stock connect, I think is the most efficient.
Okay, great. We'll have to wrap it up there. We're out of time. So this wraps up the session. I'd like to thank Ike from China Renaissance for joining me on this fireside chat, and for all participants for attending this session. We will try and work out a way to answer some of the other questions that were posted. But we will wrap it up here. And thank you for everyone attending. And on that note, have a great day. And thank you and goodbye, everyone.
Thank you. Thank you.
Thanks a lot. Bye.
It's an honor to join. Thank you. Bye.
Thank you.